Hello friends, welcome to my YouTube channel Echo Aftab. So in my today's series of Understanding Economics with Aftab, I am here with a new topic and that is concepts of national income. As in my last video when we were discussing about measurement of national income, where we understood about income method, product method and expenditure method. So in continuation of that, we can say this is the part 2 video of national income. After understanding measurement, today we will understand about concepts of national income. Today we will be dealing with what do you mean by GDP, gross domestic product, GNP, gross national product and their related variables. So friends, normally the students are having the confusion national product what it is, domestic product what it is, what are net concepts and all those things, real national income and nominal national income. All these doubts will be clear today. And thank you very much for liking my videos, for viewing my videos and sharing my videos. So if it's your motivation that many more videos will come. So without wasting any time, let us move to our slides, that is concepts of national income.
Concepts of national income. Myself, Professor Aftab Bhai. So friends, as we have discussed in the introduction, today we will be dealing with concepts of national income. Broadly, these concepts of national income are divided into two categories. One is gross concepts and the other is net concepts. Gross concepts include GDP and GNP, gross domestic product and gross national product. Similarly, net concepts includes net domestic product and net national product. So before understanding the definition of GDP and GNP, let us start with a simple example for us to better understand practically how GDP differs from GNP. So friends, on the screen you can see there is an outline map of the world. So this world map, I have taken it for us to understand the concepts. So first let us start with our country, India. So in our country, there are goods and services produced. So goods and services produced in India. Now who is producing these goods and services? Friends, these goods and services are produced by all the domestic and foreign factors of production. So here the point to be noted is domestic factors of production, that is Indian origin factors of production, and foreign factors of production. So when we speak about foreign factors of production, it refers to those factors of production who are from foreign countries who have come to India and are contributing in the production process of India. So here I have taken the example of United States of America. Let us say the foreign factors of production are from United States of America. These foreign factors of production, they come to India and Indian factors of production and foreign factors of production together contribute in the production process. And these goods which are produced in the country in India by domestic factors and foreign factors is called as GDP. So this is what is GDP. Now the question is, what is GNP? So friends, to understand GNP, let us continue from the previous example. As I said, India, there are certain factors of production in India who go to foreign countries and contribute in their production process. Similarly, if I say USA, there are few factors of production of American origin. So they don't work in America, but they go to other countries and contribute their services. And this exchange of factors of production between the countries, you can see Indian origin factors of production working in United States and USA origin factors of production working in India. They contribute something in their respective countries. So goods and services produced in USA is the GDP of USA. Similarly, goods and services produced in India is the GDP of India. As we saw in the previous slide, whatever is produced within the country by domestic factors of production and foreign factors of production is called as GDP, gross domestic product. Now here comes the twist. So let us assume that the GDP value of USA is $1,500 and in India the GDP value is $800. So till here it is very much clear with what we are speaking about, gross domestic product. Let us move one step ahead and try to understand. Now out of this $1,500, if I assume out of this $1,500, if I assume that this $100 is earned by Indian origin factors of production, and similarly out of this $800, American origin factors of production have earned $400. So what will Americans do? They will expatriate this $400 to USA, and what the Indian origin factors of production will do? They will send this $100 to India. So here you can see the respective earnings crossing the border. So here the Indian origin factors of production have sent $100 to India, and USA origin factors of production have sent $400 to USA. This is what is called as repatriation of income by Indian factors of production from USA to India, and the value is $100. Similarly, repatriation of income by USA factors of production from India to USA is $400. So this income that you can see, which the countries have earned by their factors of production, I am not speaking about within the country but by the factors of production. So the net factor income from abroad of USA is 400 minus $100. So USA had sent $100 to India and it has got $400. So the difference between $400 and $100 is $300. This $300 is called as net factor income from abroad of USA. Similarly, the net factor income from abroad of India is 100 minus 400, that is equal to minus $300. So you can see the NFIA of USA is positive and the NFIA of India is negative. So when you add this net factor income from abroad to the GDP of a country, what you will get? 1500 is the GDP of USA plus the $300, which is the net factor income from abroad. So altogether it is $1800. So friends, this is what is GNP. The $1800 is GNP. So how did we derive the GNP of USA? It is by adding up the gross domestic product $1500 plus net factor income from abroad of $300. Together we get the GNP. So can you quickly try to solve what will be the GNP of India? 1, 2, 3, 4, 5. Good. So the GNP of India will be $800 plus net factor income from abroad, but our net factor income from abroad is negative. So what we have to do is 800 minus 300, and that is equal to $500. So friends, GDP plus NFIA is equal to GNP. With this, I hope you understood the basic difference between the two terms, domestic product and national product. Then as we wanted to know the answer of the question, what is GNP? So in USA, the GDP is $1,500 and the GNP is $1,800. It is because of the net factor income from abroad of plus 300 rupees. Similarly, in India, the GDP of India was $800 and out of this $800, 300 has gone out. So the net factor income from abroad was negative. So 800 minus 300 is equal to $500. So this is what is GNP. So GNP, it refers to gross domestic product plus net factor income from abroad. This is what is GNP. Food for thought. Having understood the concepts GDP and GNP, let me ask you a question. Can you guess any one country whose GNP is more than GDP? Can you guess any one country whose gross national product is more than GDP? There are many countries, but for our reference, any one particular country. Can you guess? The answer is Japan. Why Japan? The reason is large number of foreign direct investments of Japan are in foreign countries, and this bring in huge amount of net factor income from abroad. Friends, the total goods produced in Japan, within Japan, is less as compared to the total income earned by its factors of production across the world, and that is the reason in Japan GNP is more than GDP. You can see I have taken this thing from internet, from Trading Economics. The blue shaded mark, it is very clear as to what is the case over there. If you see here, the GDP of Japan at constant prices is 5,24,854, whereas the GNP of Japan, you can see here, it is 5,47,000. Here it is 24,000. Here it is 47,000. So it is very clear that over here that the GDP of Japan is less than the GNP, or in other words, we can say GNP is more than GDP of Japan. The simple reason is because the factors of production of Japan are across the world, and huge amount of profits or incomes are repatriated to Japan. So this is how the concepts of GDP and GNP helps us to understand about the income, whether it is produced in the country or whether it is produced by the factors of production. So friends, having understood the concepts, let us see now what is GDP. So GDP, it refers to the value of all final goods and services produced within the country by domestic and foreign factors of production. So here one thing to be noticed is when we speak about GDP, we are speaking about the geographical boundary within the country, and it is by domestic factors of production and by foreign factors of production, calculated at current market price. What do you mean by current market price? Here whatever market prices are ruling in the market, that particular prices are counted in a given period of time. So this is what is GDP. So remember friends, whenever we speak about gross domestic product, it is the geographical boundary that is what is considered. You can say geographical boundary or political boundary of a country is considered. Whatever is produced within the geographical boundaries, whatever is produced within the geographical boundaries is what is within the geographical boundary is gross domestic product. Then what is gross national product? It is also the value of all final goods and services produced only by domestically owned factors of production anywhere in the world. This is the basic difference. So when you speak about GNP, here we are speaking about the thing which is anywhere in the world. It is not within the country but anywhere in the world. Anywhere in the world by whom? By domestically owned factors of production. This is the concept of GNP. So here what we are considering? So GNP is equal to GDP minus net factor income from abroad if the NFI is negative, or plus net factor income from abroad if the NFI is positive. So in case of Japan it is plus, in case of India it is minus. So in India the GDP is more as compared to the GNP. So here friends, what is considered is origin of factors of production is considered. From where? That is domestically owned factors of production. Wherever they are working, that amount, if it comes to our country, we call it as an addition to GDP, which is GNP. Now let us move on for our next set of concepts, and that is net concepts. Friends, it's very easy to understand the net concept. Whenever resources are engaged in production process, there is wear and tear of capital assets. This wear and tear of capital assets, if you take it out from the calculation, then we derive the net concepts. So when allowance is made for depreciation charges, in gross concepts we derive net values. It's very simple. Remove the depreciation charges or take out the replacement cost from the gross concepts, we get the net concepts. So depreciation charges, what it means, are the capital consumption allowance, which is also known as replacement cost. When we are producing something and if some capital asset is worn out or is replaced, that replacement cost should be deducted from the gross value to get the net value. So friends, net domestic product is NDP is equal to GDP minus depreciation cost, that is gross domestic product minus depreciation charges will give us net domestic product. Similarly, NNP is equal to GNP minus TC, and there is a slight mistake over here, error. This is GNP. So net national product is equal to GNP minus depreciation charges. So this is all about net concepts. So having understood gross concepts and net concepts, let us move ahead to understand the other concepts and the other important things that comes under the national income concepts. So GDP at factor cost. Friends, one more important thing here is, whenever we speak about GDP, we look at GDP in two ways. One is GDP at market price and the other is GDP at factor cost. So example, let us say two commodities are produced in a country with four factors of production. So here I have given an example. The factors of production are land, labor, capital and organization. And the two goods which are produced, let us say one is mobile and the other is fertilizer. So very quickly I'll read out the charges or the reward for land for producing mobile is 2000 rupees. For fertilizers, land is getting 300 rupees. Similarly, for labor it is 3000 rupees and for fertilizer 200 rupees. So capital is earning 3000 rupees and fertilizers are earning 150 rupees. So the total factors of production value for mobile is 10,000 and for fertilizer is 7,000. The story doesn't end here. When we add the indirect taxes, I have assumed here as 30% to make the figure round. Let us say 30% of 10,000 rupees is 3,000 rupees. So this 3,000 rupees, when it is added to 10,000, we get 13,000 rupees, and this 13,000 is what is called as market price. And here if you see in the case of fertilizers, In case of fertilizers, there is no tax, but in turn the government is giving the benefit in the form of subsidy. This subsidy I assumed it to be rupees 200. So now the market value of fertilizer is 500 rupees. So if you speak about what is GDP, as we saw the definition, GDP refers to the total market value of goods produced in an economy. So here it is this 13,000 rupees plus this 500 rupees together will give us GDP at market price. So our GDP at market price is 13,000 rupees plus 500 rupees. So friends, still I have not come to the topic factor cost. I am just making you all understand what is market price. This is what is market price as mentioned here. So we are speaking about market price. Then what is factor cost? So remember friends, whenever we speak about market price, all the market prices, they include the indirect taxes. All the goods are taxed, and these indirect taxes are always included in our market price. And sometimes the subsidies that is given by the government, okay, that is also a part of market price, but the market price is reduced. Let's move ahead to understand the meaning of the word factor cost. So from the above table we have understood that the GDP at market price is 13,500. So this is what is mobile's value was 13,000 rupees and fertilizer value was rupees 500. So now you tell me friends, is this amount of 13,500 rupees showing the actual income earned by the factors of production? No, because you saw it is the inflated value, because this value of 13,500, it includes the 3,000 rupees taxes, and you can see the factors of production have not contributed anything worth 3,000 rupees, yet this 3,000 rupees has come in the price. In the similar way, the market price has not included the actual 200 rupees which the government has reduced in the form of subsidy. So here there is addition of 3,000 rupees which is not necessary, and there is deduction of 200 rupees which is important. So friends, in order to know what is GDP at factor price, so to know what exactly is the value of output produced in the economy in terms of factor prices, what we need to do, we need to deduct the indirect taxes, and we need to deduct the indirect taxes को निकालो और subsidies को ऐड कर दो. So GDP at factor cost is equal to GDP at market price minus indirect taxes plus subsidies. Remember this particular formula. GDP at factor cost is equal to GDP at market prices minus indirect taxes plus subsidies. So from the previous same example of mobile and fertilizer, we'll move ahead to understand what is GDP at factor cost. So the GDP at factor cost is 10,700 rupees. How 10,700 rupees? The simple reason is, from the GDP at market price, that is 13,500 rupees, you deduct the indirect taxes of 3,000 rupees and add the subsidies of 200 rupees. So what you will get is the factors of production, the reward that they have earned. You can go to the previous slide and you can see the actual reward earned by the factors of production by land, labor, capital and organization. In case of mobiles is 10,000 rupees, and in case of fertilizers it is 700 rupees. So both these things together will give us GDP at factor cost. Here you can see. So the indirect taxes of 3,000 rupees, the indirect taxes of 3,000 rupees has been deducted, and the 200 rupees in the subsidies has to be added. So here deduct, you can see this deduction and this addition. So 3000 rupees this 3000 rupees we have removed it, and this 200 rupees we have added it. So what we are getting is 10,700 rupees. So this is what the actual GDP at factor cost. So this is what is 10,000 plus 700 rupees, that is what is our GDP at factor cost. So what is the difference between GDP at market price and GDP at factor cost? Market price includes indirect taxes and subsidies. At factor cost, we make the adjustment of indirect taxes and subsidies. So GDP at factor cost is derived from GDP at market prices after deducting indirect taxes and adding up the subsidies. So we have cleared the second step also of understanding the difference between market price and factor cost. First, we understood the difference between gross concepts. In gross concepts, domestic product and national product. Then we understood the difference between gross and net concepts, and now we understood the difference between market price and factor cost. So why it is important, this thing? Because the GDP at factor cost shows the actual income earned by the factors of production. This is the real contribution to the national income. So when there is no GDP, so remember friends, when there is no market prices available, then the factor rewards are considered to calculate GDP, and this is the income method of calculating the national income. Friends, remember the point, GDP is calculated in two ways, as I had told in the previous video of measurement of national income. GDP is calculated with output method and GDP is calculated with income method. And here when you speak about GDP at factor cost, basically we are speaking about income method of calculating the GDP. So now we shall see an interesting thing, from GDP at market price to national income. How do we derive the exact national income of the country from GDP at market price? Just three equations are there. So as we saw it, GDP at market price minus indirect taxes will give us GDP at factor cost. Just to make the thing simple, I have not taken subsidies. So again I will repeat, GDP at market price minus indirect taxes will give us GDP at factor cost. The first thing that we did was we have derived the factor cost. We have derived the factor cost from what? The factor cost has been derived from market price. Next is GDP at factor cost minus net factor income from abroad will give us GNP at factor cost. Again, this thing we had already discussed in the previous slide. So here what we are doing, we are trying to come from domestic product to national product, and this is what is, this is because of deducting our net factor income from abroad. Here we deducted the indirect taxes, here we are deducting the net factor income. Now next let us see what will happen. GDP at factor cost. So GDP at factor cost is minus depreciation will give us at factor cost, here national product at factor cost minus depreciation will give us net national product at factor cost. This is one of the most important concepts, and this is what is called as national income, GNP at factor cost. So net national product at factor cost is also called as the actual national income of the country. So friends, initially it may be very confusing, but if you see it step by step and try to understand it, if you try to induct the things into the simple concept of GDP, we come across various other concepts of the national income. So I hope you have understood now what is national income. So after understanding what is national income, let us move ahead to understand the further concepts. Personal income. The name itself suggests personal income refers to क्या? The income earned by all the individuals. So personal income refers to the income earned by all the individuals in a country, irrespective of the fact whether they are contributing in the production process or no. Even if they are not the factors of production, still they are getting the income. That income, if you take into account, then it becomes personal income. Confused? Don't worry, we will understand what it is. So friends, personal income में क्या क्या आएगा? What all things will we get in personal income? Personal income में national income आएगा, which we already seen. National income refers to what? Net national product at factor cost. उसके साथ ही साथ transfer payments. What is this transfer payments? If you have seen, those people who are retired, they get pension. These retired people, are they contributing anything in the production process? No, they are not contributing anything. फिर भी उनको income मिल रही है ना? That is what is transfer payments. Plus dividends. Many a times the corporate world gives dividends to their employees, or many a times to the shareholders. So these dividends, are they contributing anything in the production process? No, yet they are earning the income. So they are earning something, okay, without contributing anything. This is what is the income of all the individuals. Similarly, sometimes what happens, we contribute something in the production process, but we don't get the income. क्या क्या निकालना चाहिए इसमें से? You remove the contribution made to the social security. So whenever you remove the contribution that is made to the social security, such as provident fund, if you say, और अभी जो चल रहा है new pension scheme, sometimes companies को profit देना रहता है. The companies need to give the profit, but they don't give it, they don't distribute it. So all these things needs to be deducted. So personal income में there are two things. In simple words, personal income is equal to national income plus income received but not earned. देखो ऊपर see the top green, transfer payments plus dividends. Income is received but it is not earned. And in red, what is there? Income is earned but not received. So when you take into consideration these three things, national income plus income received but not earned minus income earned but not received, all these things if you add up, you will get personal income. So I hope it is clear what is personal income. Why personal income is to be calculated? Many times students of economics, they ask why all these different concepts. So every concept has its own unique way of telling few things. So personal income से क्या मिलेगा? From macroeconomic point of view, how much the economy consumes, we come to know from consumption. So if you remember the three important activities of economy: consumption, production and distribution. So here friends, and consumption is a personal matter. Therefore personal income is an important variable to understand what is happening in the economy at the macro level. It shows the exact income that households earn in an economy. It may be as factor rewards or it may be as transfer payments. Now you can see today in the days of coronavirus, what is happening? Most of the migrant laborers are moving to their villages, moving to their cities, moving to their houses. They are not earning anything, and the government is trying to make a provision to add 5,000 rupees, 2,000 rupees in their bank accounts. This 5,000 rupees which the migrant laborers earn, they are not earning it, they are getting it. There is a difference between earning and getting. So this amount what they are getting becomes the transfer payments. If they would have earned it, it would be by the contribution in the production process. So friends, personal income shows the purchasing power of the people, and purchasing power of the people is very important because it decides the aggregate demand in the economy. That is the reason we try to understand why personal income. Next is personal disposable income. What is this disposable income? Everything that we earn, many a times we don't spend, or we are not allowed to spend. Who doesn't allow us to spend? The government doesn't allow us to spend. What do you mean by the government doesn't allow us to spend? इसका मतलब disposable personal income represents what people actually have that they can spend. So here it is calculated by deducting direct taxes. So personal disposable income is calculated by deducting direct taxes and one more thing, non-tax payments. If you have seen, when we are speaking about GDP, and in GDP we are speaking about indirect taxes. So if you remove indirect taxes, you get factor cost. So similarly, after earning the income, the factors of production, they need to pay the taxes to the government, and after paying the taxes, whatever remains in their hands is personal disposable income. Sometimes we don't follow the rules of the government and we need to pay fines or we need to pay penalties. These fines and penalties are the payments done by the people to the government, but they are not in the form of tax. Such payments are called as non-tax payments. So personal income say remove direct taxes and non-tax payments, then what you get is called as personal disposable income. Personal disposable income is equal to personal income minus direct taxes. Friends, in most of the textbooks they limit themselves only to these two concepts, only to these two parts. No worries, बहुत सारे टेक्स्ट बुक्स में only this much is given, that is personal disposable income is equal to personal income minus direct taxes. This also चलेगा if you include minus non-tax payments also, but including non-tax payments also gives a clear picture as to what amount of money people have with them to spend. So dispose कितना कर सकते हैं, that is what is, आपके personal income में से कितना dispose कर सकते हैं, that becomes personal disposable income. So friends, we have covered maximum concepts of national income. One more concept is there, that is called as per capita income. Per capita income मतलब क्या, national income कितना है, population कितना है, just try to find out the average of that. So per capita income refers to the income per head of the country. National income divided by population will give us per capita income. Now we shall see the relationship between all these national income aggregates. So friends, whatever we have studied in the previous slides, all these things I will try to bring it in one slide so that it becomes more clear to you by adding or by removing what from what you derive at what. So let us say GDP at market price. We understood what is GDP at market price, goods and services produced within the country calculated at market price is GDP at market price. So इसमें से हम if we remove depreciation from GDP, what we get? 1, 2, 3. Got it? GDP minus depreciation. So from gross concepts, if we remove depreciation, we derive the net concept. So here comes NDP at market price. So from gross concepts, if you deduct depreciation, you get NDP. From GDP, if you remove indirect taxes, what will you get? So GDP at market price minus indirect taxes, we get GDP at factor cost. So please pay attention, try to focus. I have just brought two variables, depreciation, gross में से depreciation निकालेंगे तो net मिलेगा. Similarly मार्केट प्राइस में से इनडायरेक्ट टैक्सेस निकालेंगे तो क्या मिलेगा? फैक्टर कॉस्ट. सो दिस एंटायर स्लाइड आई विल बी फोकसिंग ऑन दिस थिंग, सो प्लीज पे अटेंशन ऑन दिस वर्ड्स. सो फ्रॉम G if you remove depreciation, we are getting N. Similarly, from market price, if you remove indirect taxes, what we are getting? Factor cost. The entire this particular slide is filled with this particular thing. Now we'll go ahead, we'll try to understand. From NDP at market prices, if you remove indirect taxes, what will you get? What will you get? We will get NDP at factor cost, क्योंकि indirect taxes निकाल रहे हैं. Similarly, from GDP at factor cost, if you deduct depreciation, what do we get? We get NDP at factor cost, net domestic product at factor cost. So this is all about domestic product. Domestic product मतलब क्या? The goods and services which are produced within the country. इसमें और एक angle, one more dimension will add. We shall try to bring into the picture net factor income from abroad. So friends, from GDP at market price, if you deduct net factor income from abroad, what will you get? We are moving from domestic concepts to national concept. GDP at market price. Now again the same thing will continue. From GNP at market price, if you remove depreciation, what will you get? You will get NNP at market price. If you remove indirect taxes from GNP at market price, what will you get? You will get GNP at factor cost. Now see the concepts: NDP at market price, NNP at market price, and GDP at factor cost and GNP at factor cost. So GDP at factor cost, if you remove net factor income from abroad, you get GNP at factor cost, and from NDP at market price, if you remove net factor income from abroad, you get NNP at market price. Now the last two things are remaining. From NNP at market price, if you remove indirect taxes, you get NNP at factor cost. Similarly, see this particular circle that is left over. From this GNP at factor cost, if you deduct what, you will get NNP at factor cost. Quick guess, very quickly. Gross से national, right? We need to deduct depreciation, and here we complete all the relationships between all the different aggregates of national income. So if you see, there are only three things. One is in red, depreciation, the other is in blue, indirect taxes, and the last one is in yellow, that is net factor income from abroad. If you remove these three things, you will get the other concepts. It's very simple to understand. Unnecessarily students get confused with the various concepts of national income. So the summary of all these things will be in the next. देखो NDP at factor cost से net factor income from abroad निकालो, you get NNP at factor cost. So to summarize the relationships, you can see, if you deduct depreciation from gross concepts, we get net concepts, which we understood in the earlier slides. If you deduct indirect taxes from market price, you get factor cost, which we understood with the example of mobile and fertilizers. If you deduct net factor income from abroad from domestic concepts, we get national concepts, America and India, the first slide example. So this is all about the various concepts of national income. So before ending the class, I would like to bring into picture one more concept normally students should know, and that is nominal GDP and real GDP. Nominal GDP and real GDP. Another 5 minutes, I will be concluding the session. So what is nominal GDP? Friends, nominal GDP में we take into account, in nominal GDP, we take into account what we call as the current prices. Whatever market prices are there right now, we take into account. So friends, nominal is related to current prices. Real GDP takes into account the value of the goods on the basis of constant prices. So when we speak about real GDP, when you speak about real GDP, this real, it refers to the value that we are taking into consideration at constant prices. This is what is the difference between nominal GDP and real GDP. The extent of difference between nominal GDP and real GDP, we get what is called as the rate of inflation. एक इकोनॉमी में इन्फ्लेशन कितना है ये समझना है तो we need to know what is the nominal GDP and what is the real GDP. So to explain this thing, I will take a numerical example. So adjusting GDP for inflation. Let us say there are two commodities, television and mobile, and we are taking two time periods. One is in 2010 and the other is the recent 2020. So in 2010, what was the quantity of TV that was produced and at what price? And similarly, mobile, what was the quantity and price? And today, what is the quantity and price of these two commodities? So let us say in 2010, that 200 units of television were produced at 5,000 rupees and 400 units of mobile were produced at 3,000 rupees. Can you friends tell me what is the GDP? Very quickly. Yes, right. Quantity into price, 200 into 5,000 plus 400 into 3,000. So this will give us the GDP, nominal GDP of 2010. In 2020, what has happened? The price has increased, the quantity has more or less increased and decreased. More or less it has increased. So here, if you want to know what is the GDP of 2020, so here friends, please pay attention. Here, this 200 rupees, sorry, this 500 rupees becomes the current price of 2010. Similarly, here पे this 10,000 rupees, this rupees 10,000 rupees becomes the current price of 2020. Remember this thing. We'll move ahead. So nominal GDP in 2010 is how much? 5,000 into 200 plus 3,000 into 400, that is equal to 22 lakh rupees. Well, see, what is the nominal GDP in 2020? So it will be 10,000 into 300 plus 6,000 into 500, that is equal to 60 lakh rupees. So यहाँ पे will be very happy because in 2010 it was 22 lakh and now it has become 60 lakh. This is what is the nominal GDP showing us the picture. Now let us try to see the real GDP. So real GDP in 2010, it will be the same because it will be the constant prices. But what is the case with real GDP in 2020? So here friends, what we need to do is we need to take into consideration, this is the main point of discussion, we need to take into consideration the price of base year and multiply it with the quantity of current year. Similarly, price of base year and multiply with quantity of current year. Then you will get the real GDP. So here it will be 5,000 into 300 plus 3,000 into 500, which is equal to 30 lakh rupees. जब हम nominal देख रहे थे, what was the situation? It was 22 lakh in 2010 to 60 lakh in 2020. But when you are seeing the real value, what you are seeing, it was 22 lakh in 2010, but only 30 lakh and not 60 lakh. This is how it will show the true picture of the economy. यहाँ पे हम क्या कर रहे हैं? What we are taking into consideration? The price, whether we are taking into consideration current prices or base year prices. Base year price को we also call it as constant prices. So the summary of nominal and GDP. Nominal GDP in 2010 was 22 lakh. Real GDP in 2010 was 22 lakh because we have considered only one price, 1 year, 2010. Now coming to the crux of the discussion. Nominal GDP in 2020 was 60 lakh, but real GDP in 2020 is how much? As we saw, it was only 30 lakh. So if you want to know what is the GDP deflator, the formula is GDP deflator is equal to nominal GDP divided by real GDP. So nominal GDP कितना है यहाँ पे 60 lakh rupees, real GDP 30 lakh rupees. So GDP deflator is equal to 60 lakh divided by 30 lakh. I'm very sorry. It is 60 lakh divided by 30 lakh and the answer is 2. Friends, how to interpret the value 2? What do you understand by this value 2? It simply shows that rate of inflation, prices have doubled, the rate of inflation is 100%. Okay, so this is what is GDP deflator. So I hope you have understood 4 important points: gross concepts, net concepts, market price, factor cost, and then later you understood about personal income, personal disposable income, and lastly you understood what is real income and nominal income. So friends, we have come to the end of the session. I hope you have understood and you enjoyed the different concepts of national income. So keep visiting Understanding Economics with Professor Aftab on my YouTube channel Echo Aftab. Thanks for watching. Take care.